Welcome to the Small Business Tax Savings Podcast, powered by Jetro. Each week, we bring extremely valuable accounting and tax tips specific to small business owners. You will be on your way to growing your business and putting more money in your pockets. Here's your host.
Hello and welcome back to another episode. Today's topic is, how do you get profits out of your business? Now, before we get into that, this episode is brought to you by Jetro and the Tax Minimization Program, which is a do-it-yourself training program to ensure that you pay the least amount in taxes as legally possible. I am your host and founder of Jetro, Mike Jesowshek. Again, today's topic is, how do you get profits out of your business? And this is a question that I actually get all the time, and one that we just saw in our free Facebook group, which brings it up. If you are not part of our Facebook group, go and join right now. Go to Facebook, type in Small Business Tax Secrets, answer a few questions, and become part of our Facebook group. But this is a question that came up in that group. How do I get money out of my business to use personally? And another one that relates to this that we see often is, my business bank account has no money in it. How am I showing a profit? Why do my financials, why does my tax return show a profit when there's no funds sitting in the business bank account? So that's exactly what we're going to discuss today. The first question we want to talk about is, what is an owner's draw versus a salary? And again, how do I take money out of my company? And when we look at owner's draw versus salary, we need to first look at your entity type and then kind of discuss the options. So salary is the same thing as payroll, and this is one possible option to get money out of your business. Now, if you've been listening to us, you know that if you're organized as an S-Corp, you are required to take a reasonable salary as an owner. You're required to be a W-2 employee of your company taking a reasonable salary. So if you're an S-Corp, this is one way, and a requirement of yours is to take money out of the business via payroll or salary to yourself as the owner. However, if you are a sole proprietor, a single member LLC, a member of a partnership, you are not allowed to take a salary as the owner. So that's one key thing to note, that this is not an option for you. If you're a sole proprietor, single member LLC, or a member of a partnership, you're not allowed to take a salary as an owner. With an S-Corp, you're required. Now, payroll involves calculating and withholding taxes and then making those tax payments and doing those tax form filings to the respective agencies. So payroll can be complicated. If you're an S-Corp and you're not running payroll yet, you want to make sure you start that because that's required by law. And typically we recommend using a payroll provider for this. Reach out to us in the Facebook group. We can recommend you to someone, a payroll provider that we know, or we can help you out on our end as well. Payroll is considered a business expense and will reduce your business income or profit. So if you have $100,000 in income or profit, and then you run payroll on top of that of, say, $40,000, now you're going to have $60,000 in profit, 100 minus 40. So payroll is considered a business expense and will reduce your business income and profit. The next way to get money out of your business is an owner's draw, or an owner's distribution, or sometimes called an owner's dividend. Basically, these are all the same. An owner's draw is simply transferring money from your business account to your personal account, or writing a check, or taking cash out, whatever it might be. But it's simply transferring money, taking money out of the business and taking it personally. That's it. It's as simple as that. There's no tax withholding on a draw. But keep in mind this one next piece. As an owner draw or a distribution is not considered a business expense and therefore does not reduce your business income or profit. So if you have profit of $100,000 and you take $100,000 out of your business, you still have profit of $100,000 because an owner's draw is not an expense to the business. Payroll is, but an owner's draw is not. So that's the second way that you can get money out of the business. Finally, guaranteed payments. And these are going to be available to partnerships only. So if you're in a partnership, this is where guaranteed payments come into play as a possible option. Essentially, guaranteed payments are similar to a salary, but they're compensation to members in a partnership for time or services that they provide to that partnership. And remember that partners are technically not able to be on what we call payroll. Now, they can take guaranteed payments, but partners cannot be on payroll if they're the owner of the company. Guaranteed payments are made whether or not the business is successful. mention or key in on that note, guaranteed. And their guaranteed payments are usually decided upon directly in the operating agreement. So you might be joining a partnership where they say, we have 3 partners, one's going to be more involved than the other, so we're going to do guaranteed payments where he gets $5,000 a month or something like that. That would be typically how guaranteed payments are arranged. Guaranteed payments are a business expense and would reduce the business income or profit, but that partner that's receiving that guaranteed payment will report all that income received on their return. It's going to be part of their K-1 filing. So when we look at how do we get money out of our business, there's a couple different options. If you're an S Corp, payroll or salary is going to be one option. Now you're going to use your payroll and salary and an owner's draw more than likely, but payroll salary is going to be one required option. If you're a sole proprietor, single member LLC, or a member of a partnership, payroll is not an option, at least for you, the owner. So the main way people are going to be getting money out of their company, if you're an S Corp, after you've taken your reasonable salary, is through an owner's draw or a distribution. And again, this is simply transferring money from your business account to your personal account. Now, it's key to note, again, payroll is considered a business expense and will reduce your business income. Owner's draw or distribution is not considered a business expense and therefore does not reduce your business income or profit. So that leads up to this next question. My business bank account is empty. Why am I still showing a profit? So let's look back at those options above. And again, let's remember that in this discussion, we're assuming cash basis accounting. Cash basis accounting means basically when items get recorded as they occur. So you have incoming deposit from a client that is recorded as income in the month that the cash is received. And you have an outgoing expense that's considered an expense in the month that the item is actually paid. So you have cash, you just complete a job, they pay you $5,000 in March and $10,000 in April. On a cash basis accounting system, you're going to show income of $5,000 in March and $10,000 in April when that cash was received. And the same thing with an expense. Now, there is one caveat. If you do a credit card, you can take that expense on a business credit card when it occurs. So if you charge $1,000 of software expense in March and you make that payment on that credit card bill in April, you're going to get that expense in the month that it occurred, which would be March, even though you didn't make the payment until April. That's only for credit cards. So when we think about why our business bank account is empty, but we're still showing a profit, we need to understand how financial systems work in accounting. So we need to look at an income statement. We need to understand the balance sheet. We did a whole series on this last year, so I don't want to get into this too deep. Check out previous episodes on everything you need to know about bookkeeping. We talk about what is an income statement, what's included in it, what's a balance sheet, and what's included on it. Basically, a big general kind of brief summary here is that an income statement is going to be what you pay your taxes on. That's going to be your profit or loss from your business. There's some items like owner draws, principal payments on a loan that show up on a balance sheet and do not show up on the income statement. And that's where you're going to have those discrepancies on why you might have a profit with no cash, is because there's some payments that do not show up on the income statement and instead just affect the balance sheet. So as discussed above, owner draws are not expenses. So as you transfer money to your personal account via an owner draw, the money leaves the business but does not reduce the income. So let's go through a few facts and just kind of put some numbers into practice here. Let's say you have business sales of $200,000. You have business expenses prior to any kind of payroll of $60,000. And then you have payroll expenses, and this includes payments to an S Corp owner of $45,000. Finally, you take an owner draw of $80,000. So let's look at what does this look like. Business profit is going to be $95,000. That's business sales of $200 minus expenses prior to payroll of $60. Now we're at $140 minus $45,000 in payroll, which brings us to $95,000. So our business profit in this example is going to be $95,000. And note, the owner draw did not reduce profit. So that $80,000 in owner's draw did not reduce the profit. Now let's look at the bank balance. Our bank balance is going to be $15,000. And again, this is assuming that the only activity in the business account was the items that we discussed here with no beginning balance. But that bank balance is going to be your sales minus your expenses minus your payroll minus your owner's draw. But we're going to be paying taxes on profit, not our bank balance. And so that's where we kind of see that difference. Business profit was $95,000, bank balance was $15,000. That difference specifically is $80,000, and that's going to be the owner draw amount. So remember, the owner draw does not reduce income. That's just a balance sheet item, which is why you might show profit with no money, is because that was not an expense. Instead, it's a balance sheet item. There are a few other reasons that you might show profit but not have any funds in the bank account, and that would be loan payments. Only the interest piece of a loan payment is deductible. The principal is not. That is just a balance sheet item. So let's say you're paying off a loan and the loan amount is $20,000 and you paid $5,000 in interest. You would have $5,000 in interest expense that would reduce income, but the principal piece of that $20,000 would just be reduce your loan balance on your balance sheet, not a business expense. The second piece is credit card payments. You get the tax deduction when the transaction occurs. So if you make a credit card payment in, say, December 30th, you pay Jetro for your tax service $1,000, but then you pay that bill in January. You're going to get that expense in December, not January, because that's when the transaction occurred. So sometimes there's going to be some timing difference too that might kind of, when you make that payment in January, you're going to show money going out, but no corresponding response or no corresponding expense because you already took it. So that's really it. The next time you're wondering how do you get money out of your business, you know the options that are available to you. Again, payroll or salary. This is only available for S Corp or C Corp owners. Owner's draw or distribution. This is going to be the main way people get money out of their bank account, business bank account. Again, that's just transferring money from your business account to your personal account. There's no withholding. There's nothing like that, because ultimately there's no withholding because you're paying the taxes on that draw when you file your tax return, because that's not a business expense. If you're in a partnership, you do have the option to also do guaranteed payments. So I hope that was helpful. Hope that helped answer some questions on how do you get money out of your business bank account? How do you take the profits that you received and take them out of the business bank account? One last thing I want to talk about before is, again, check out our free Facebook group. Just search into Facebook Small Business Tax Secrets. I also want to remind you about our tax minimization program. This is a program that we spent years building out, and basically we have a library of tax strategies and implementation guides on how you can implement these strategies starting today to start saving taxes. You have access to our team to ask an unlimited amount of questions of general tax questions that you might have for us. We have a private Facebook group, a monthly group training session where we go over a topic, answer questions that our members have, and things like that. So definitely check out our tax minimization program. We've heard great feedback so far, and you can sign up for that at taxsavingspodcast.com/tax. That's taxsavingspodcast.com/tax. Again, thank you for listening to another episode, and I will see you next week.
This has been another episode of the Small Business Tax Savings Podcast from the team at Jetro. If you enjoy our weekly episodes, please leave a review on whatever platform you listen to us on and share with other business owners. If you have any questions or future topics you want to hear, email them to tax@jetrotax.com. Thanks for listening and have a great day.